Buonasera a tutti. Good evening to everybody. I immediately switch into English, which is the established language of today's seminar or webinar, where we have the great pleasure to have Matteo Maggiori with us as a host. So first of all, thanks Matteo from being here, or better, from being here from San Francisco, where I think you are in this moment. In the very first time, that is before COVID, we established and defined some months ago this meeting in Rome, in the well-known by all of us Sala delle Colonne. So we are in any case very happy to have here Matteo today with us in the same, not in the same way, but to have also with us. Matteo is a very well-known international economist, Lewis alumnus, sorry, and the most recent award that I would like to mention is the Carlo Alberto Medal, which is the award which is given to the best Italian economist under 40 years old. Today, our topic is another key part of the picture and the scenario that in our life and in our profession or different and several professions we are going to deal with, and it is the international monetary system in the debt world. As Mario Draghi commented some weeks ago on Financial Times, debt is for sure one of the world of the after-COVID world. Is exploding everywhere, and to deal with this world is one of the challenges that policymakers and all people working in the worldwide economy will have to deal with. Before giving immediately the word to Matteo, some rules of game. As usual, there will be an introductory speech that this time we will try to keep particularly brief to leave the maximum possible room to interaction and questions. So feel free to ask questions since the very beginning through the chat. I will read the questions and comment with our speaker. I think I have taken even too much time, so please, Matteo, the floor is yours.
Well, thank you so much for having me here virtually. First of all, let me just say, I know that Italy has gone through an extremely rough few months, and I wanted to extend my thoughts to everybody, particularly in Rome and the surrounding areas of Italy that has had to deal with this. We've been relatively blessed so far in San Francisco, where I live, where the conditions have been substantially easier. But I do want to express, my sympathy to everybody that has had to go through a serious lockdown and is struggling economically. It's also a pleasure, of course, to be back, at least virtually, at my home university, where I did my undergraduate some years ago. But let me not take too much time to reminisce. Let me get into the main topic of the day, which is I was asked to give a talk about my research, but also about things that most of us should care about. What are big risks for the international monetary system? What is the international monetary system in the first place? You want to think of it as it's an agreement or a set of conditions globally that tell us what do we hold our investments in if we want safe assets. So you could think of, Florence under the Medici with the Florint. You can think of England in the 1920s, or you can think of the US today, where the US dollar and the Treasury debt are the ultimate safe asset. If you want to save in something that you think is going to hold up its value, even during a big crisis, you tend to do so in dollars all around the world. Now, this is important because crises that end this kind of arrangement, transitions from one type of system to another, tend to be a very big and negative global events. And so as economists, we tend to worry about these type of events, even if they're infrequent. Now, I want to be very clear that today we're going to talk about the short run and the long run. Now, in the short run, the system is very unlikely to change. The US is a very solid, large economy. The debt levels are high and growing, but they're relatively low from a global perspective. So I don't think anything I'm going to say applies to tomorrow or the day after the next year. However, as an economist, I try to think about the next 10 years, try to anticipate things that might change, particularly if they're likely to be negative for the world economy, so that should they happen, we have spent some time before thinking through the mechanism, accumulating empirical evidence, trying to think about, should this happen, how would we mitigate the negative consequences, or is there anything that we can do beforehand to try to mitigate the probability that this might even happen in the first place. So I'm really going to focus on emerging risks down the horizon rather than something that it's for the here and now. Now, most of us, at least people my generation, have lived through three crises. I went to school in Berkeley, which is in California, to do my PhD, and I started in 2007. The financial crisis hit immediately after. And I then graduated. I was doing my first job as an assistant professor when the sovereign debt crisis in Europe hit. And now I am a tenured professor and COVID hit. So through my professional life as an economist, I've seen three crises that are fairly large. They're supposed to be rare events that are now not to be so rare. And I think that one has given me an interest in thinking about what else is on the horizon. What else should we worry about? Even if most other people might not think that that's something that we should worry about. I do think that a big part of our job as research economists is to think about these risks, these tail risks that are not necessarily at the forefront of the debate right now. Now, let me introduce this. So if you think of like American federal debt, so this is US federal debt, US treasuries held by the public. So I'm going to exclude the debt that is held by the central bank, because you can think of that one a little bit as an inside transfer among two government agencies. And there are reasons why that might be interesting, but let me ignore it for now. Well, if you look at where this was in 2006, it's around 36%. I mean, that's an extremely low debt level over GDP. That means that you have ample ability to expand the debt over GDP ratio without really having to worry about fiscal constraints. As an economist, we think of that one as having dry powder. It means that if a crisis were to come, you can sort of deal with it by, for example, doing fiscal policy and borrowing to finance the spending. That's precisely what the US did during the financial crisis. And I do think as an economist that a lot of those expenditures were well justified to deal with an immense financial crisis and make sure that the real economy kept as stable as one could and kept growing or could emerge from the crisis relatively unscathed in a way that would still generate growth. So by 2019, the American debt to GDP ratio, it's now around 79%. Now with the current crisis, the US federal government is again resorting to fiscal policy and borrowing for part of the financing of this policy. And so if you look at official forecasts of where the debt to GDP ratio will be in a few years, it might be close to 100% debt to GDP ratio. That's one of the highest debt levels that the US has experienced, certainly in the last half a century. I think you have to go back to the situation that the US had when they emerged from World War II. So financing the war required huge fiscal expenditures. A lot of it was financed with debt. So when they emerged from World War II, they had very high debt to GDP ratios. But other than that, in relatively, in peace times, we haven't seen something like this. Now, as an economist, you have to think about, do we have to worry about this? Probably not in the short run. I'm one of those that thinks that there's a question on the chat that says, I'm sorry, as we're supposed to be seeing slides. The answer is no. I thought I would not torture you with slides from my own papers. And by the way, the person asking the question is Salvatore Nistico, who I remember very well because he was a It was one of my TAs, I think, when I was a student at Lewis, and he's a very good economist, so I'm very glad to see him here. As I was saying, the way you want to think about this is, for the current crisis, the US is resorting to fiscal policy again. I'm one of those economists that probably thinks that that's a good idea. That's what we should be doing to make sure that we can smooth as much as possible the COVID shock and that we reemerge from these crises as unscathed as possible. However, we have to think that none of these things are free. There are certainly theories or economists out there that would like us to believe that this is all free. I do have to say I'm a skeptic. I do think that there are fiscal constraints. For the US, these constraints are more relaxed than for other countries, precisely because the rest of the world wants to save in dollars because they're safe assets. But you have to ask yourself, why are they safe? Well, they're safe precisely because there is an expectation that in a crisis, in the next crisis, the US will not only repay its debt, but will also pursue a combination of monetary and fiscal policy that will not depreciate the dollar. Think about it. Suppose that you're European and you're holding US treasuries because you think that on a rainy day in the next financial crisis, they're going to be a safe asset for you to have. Well, that statement really comes in two parts. One is you think that the US will not default, they will repay you the nominal value of the debt. But the other component is you think that the dollar will not depreciate massively against the euro in that crisis. If that were the case, as a European, you will be receiving a lower payout for your holdings. So that puts a constraint on the US of having to maintain during crisis the stability of its debt and the dollar. And that does include ultimately not inflating away or not pursuing a fiscal policy that is going to threaten the stability of the currency in international financial markets. So that's what we have to worry about. So as an economist, when I see the debt to GDP ratio skyrocketing as it has over the last 10, 15 years in the US, you start seeing that ability being eroded more and more. Now, as I said, this is not a worry for today. We're still at relatively benign levels, but it is something that we have to start thinking about. You don't want to end up in a situation where you let the debt run up, a crisis comes and there is no more dry powder. That's going to affect not only the US in its own ability to fight domestically a future crisis, but particularly because its currency and its debt solve this or have this very big international role, that problem will spread very quickly to the rest of the world that has accumulated its rainy day funds in this currency, thinking that they're going to be there, and precisely at the worst possible time in a future crisis where they would like those funds to be safe. If those don't pay out, that can have very large negative consequences. Now, I want to, before I open up the floor more and more, I want to talk about some historical precedents. So one of the biggest syndromes that I've seen, in some part, even in my profession, but certainly among the non-professional economists, is the idea that the US will always be safe. At some level, it sounds a little bit surprising to even think of the US as a source of a possible problem on financial stability globally, rather than the ultimate source of stability. And that's fair. In fact, for the last two crises, the financial crisis and the current one, the dollar has been a good bet. The dollar appreciated strongly against the euro and against other major currencies, with the exception of the yen, in the aftermath of the financial crisis, essentially in October 2008, after Lehman Brothers failed. That's really an extraordinary event. There are very few countries in the world that experience a banking crisis. In some sense, the financial crisis was concentrated in the US and have a currency that actually appreciates. What you normally associate with a banking crisis in any other economy, it's a capital flight and a big depreciation of the currency. That's what I call the reserve currency paradox. For the US in 2008, we saw the opposite. We saw a crisis that was in some sense US-led or US-centric, and yet when one of the major banks of the US failed, you actually experienced a dollar appreciation and more demand for safe assets in dollars. I think this one has convinced a part of the investors that the dollar will always be safe, that there's a lot of commitment, a lot of fiscal space. And in my own empirical work, I have documented that global portfolios, by which I mean the portfolios of institutional investors, have over the last 10 years drifted more and more towards holding dollars and instead moved away from the euro, which I'm going to return to in a few minutes. To me, as an economist, that concentration of expectations that the dollar will be extremely safe, concentration of portfolios, so global holdings, more and more into dollars, when at the same time, you see the US economy on a secular trend of being a smaller part of world GDP and having higher debt levels, that is a combination that I start to worry about. Again, the worry is not about tomorrow or the day after, but it is something that it's on the horizon and that I think as economists we should be discussing. Maybe we even want to dismiss it ultimately. Maybe we want to conclude that, yes, it is a worry, but it's relatively small and we're happy to live with it. It's one of the many things that we have to sort of live with in second best, or maybe not. But I think that not asking those questions, not doing research on it, for the policymakers not to think hard about it, that would be a mistake. And normally the things that we don't think about and we don't prepare for are precisely those that tend to happen because we're not prepared and the system sort of dynamically goes there. I also want to point out that from an historical perspective, it's somewhat strange to have this assumption that nothing ever changes and that the country at the core of the system will always be safe. To give you a very brief historical perspective, if you look at what happened in the 1920s, England was essentially playing the role of the US today. And England had a stellar reputation, had a large empire. It was very committed to keeping sterling safe. So I would say that it had a reputation at least similar to the one that the US has today, if not even to a greater extent. But in 1931, England actually decided to go off the gold standard. What does that mean? It means depreciating or breaking an exchange rate parity with gold. What that really means in layman terms is they depreciated their currency. So if you were holding sterling debt, you would be making a loss. In fact, the Banque de France, the Central Bank of France, that was the largest holder of sterling debt, was almost bankrupt by this abrupt depreciation of the pound. And that caused a fair amount of resentment between the two central banks for a number of years. Why did they do it? They do it for the same reason that every other government before them did it. They got themselves into a position at the beginning of the Great Depression where paying the debt would have required taxation domestically and a fiscal strain that was too high or too inconvenient on the domestic economy compared to depreciating the currency and losing some reputation for the international investors as being the kind of country that does not depreciate in a crisis. So you really want to think of it as a game between, well, on the one hand, I want to have a very good reputation because ex ante, that gives me a lot of demand for my debt. I can borrow cheaply. My firms can have access to a lot of foreign capital. That is advantageous. On the other hand, they're giving it to all this capital to me because they think that I'm committed to keeping it safe during a crisis. If when the crisis comes, I don't deliver, they might not trust me again. I might lose this privilege of getting this global demand for my asset. So you want to think of 2008 instead as being a situation where the US delivered on the promise that the dollar was going to be safe. And that one, in some sense, has enhanced the reputation of the US as a provider of safe assets globally, in my view. But again, England, when they really got into trouble, eventually they had to let it go. So there is no reason to believe that these things are immutable. They certainly last for a very long time. We've only seen 2 countries in over a century playing this role. But it is the wrong assumption to think that there's something fundamental that will never change. The second thing I want to touch on that brings us closer to the euro and to the situation in Europe is the common idea that there is no alternative. So to give you the story of where this comes from, in the 1960s, a Belgian economy called Robert Triffin diagnosed that the US was going to eventually have to abandon the Bretton Woods system. The Bretton Woods system was the system that emerged after the World War II and lasted until the 1970s, that was US-centric on exchange rates on a parity. It was essentially the promise that the US will keep the dollar stable in terms of gold, and everybody else will keep their currency stable in terms of the dollar. Triffin said, look, this is not going to happen. There is growing and growing demand for US debt. It is precisely this demand that is going to lead to the demise of the system, because the US will expand its balance sheet, the debt will grow, and at some point they will find it that it's too expensive from a fiscal perspective to repay the debt rather than depreciate and lower the real value of the debt. I think Triffin, it's fair to say, his prediction was largely derided when he made it in the early 1960s. And actually, as a curiosity, I believe that the prediction was made at a conference in Rome at the Banca Nazionale del Lavoro. But 10 years later, that's precisely what happened. The US went off the Bretton Woods system, went off gold in 1972. By 1973, exchange rates were floating. However, contrary to what happened to the British pound in the 1930s, the dollar did not lose its centrality. As you know, the dollar today is still central to the system. And one conjecture that people have is that the reason was there was no alternative. In Switzerland, it's too small to have a large stock of debt, even if it's perfectly safe. Europe was too fragmented. Asia was closed to capital flows. And so people had to stick with the dollar. And this sentiment has been extrapolated to today to say that the euro has so many fundamental design flaws that it's unlikely to play a global role. And in fact, my own research shows that since at least the global financial crisis, whatever international role the euro had, if anything, seems to have diminished. The Chinese renminbi, it's probably too early. China needs to open its capital markets. It needs to let more people trade the currency. It has its own problems. And so people think that that's 10, 20 years down the line. And so they think that in the immediate, in the short run, there is no alternative to a dollar. And while I'm sympathetic to some of those arguments, I do think that it's foolish to use that argument to simply forget about the problem. Economists used to say that financial crises happen very slowly and then all at once. And I think this is particularly true for the global monetary system. It's sort of, these crises tend to be a problem that accumulates slowly over many years, and then they hit you very, very quickly. And so I think, I want to warn against a sense of complacency that because there is no alternative, we shouldn't worry. I think alternatives are starting to emerge. It's early, and we certainly have a number of years before they're viable, but I don't think there should be a cause for not thinking about the problem. So I think I've already spoken too much, and I'm sure that some of you have questions. So let me stop here and just really open it up. And as I told the organizers, I'm happy to take questions from the chat. If some of you want to speak up directly, I'm also happy to sort of speak directly to you. And similarly, if by any means you're feeling a little bit squeamish about asking questions in English, do feel free to ask them in Italian, and I'll give it my best shot to read them aloud in English for the rest of the audience.
Thank you very much. Thank you very much, Matteo, for this a really inspiring picture of what we have in front of us, but also on the basis of what we have behind us with your historical examples. I will ask the first question, so I will exploit the privilege to be the moderator, and then I will leave the stage to the ones that are already arriving. My question regards the so-called digital values, Libra, Digital One, and the digital euro, which is under discussion now. So these are different examples because there are at least two clusters, the private digital values like Libra and the public scheme that different central banks, but in particular, I would argue the Chinese central bank are designing. My question is, in general, what is your view on these experiments? Is that at least in the long term, which is the time frame that you have chosen for your points and for your arguments, can have an impact? And in particular, if this comes from private experiments or is more obvious that come from public experiments, and in particular from the Chinese one. So at the end are three questions, but they are all strictly connected. So please, the floor is yours.
Perfect. Those are super interesting questions. I think there's a lot of buzz around digital currencies, stable coins. So let me distinguish three broad categories. One is things like Bitcoins. Those are just a non-starter. Okay? They're just some fancy element for spread betting. If you want to bet on sports, you bet on sports. If you want to bet on something that is digital, be my guest. But I think they have really I don't think they have any significant role to play in the international monetary system. They seem to not respect the fundamental characteristic that investors want for an international currency, being extremely stable. I mean, Bitcoin has been enormously volatile, and there is no reason to believe that it wouldn't have that feature intrinsically. A very, very different animal are stable coins, like Libra. Now, my understanding of Libra is somewhat limited, but I would say that there was a Libra number A and a Libra B. The Libra A is what Facebook announced at the very beginning, which was this grand project trying to really provide something that looks like a currency. As an economist, when you think about a currency, you think about three things. It's a store of value, so it's what you put your savings in. It's a transaction medium. It's what you and I can exchange to have a cappuccino in a bar. And it's a unit of account. It's what you and I might agree to denominate a contract in. If you were to hire me for something, you might say, I'm going to pay you in these units of account. I'm going to pay you in Libra. I'm going to pay you in dollar. And Libra, the first project, really seemed to me to want to occupy all three roles. And I'm going to argue that there might have been a slight lack of understanding that the three roles are extremely different. And in particular, the worry that we have about each of the role is quite different. A method of payment, it's not that different from PayPal. It's electronic, it's very fast, it's convenient. There are many rules that get attached to it about money laundering. There are many rules that get attached about capital controls. But frankly speaking, I would imagine that if you're extremely competent as a company, you can do it. I mean, PayPal does it. I'm assuming they do it well and all this. The unit of account, I think, again, it's something that we do worry a little bit about, particularly if it's sticky. An economist defines sticky to be once we define the price in that currency, we're somewhat unwilling for many reasons to change it. But if it was fully flexible, I mean, if you don't want to count things in dollars and you want to count them in oranges, you can be my guest. It should have no effect as long as prices are flexible. It's a very different game once you talk about the store of value. Once you're letting people save potentially trillions of dollars in that vehicle, then we have to go back to what I was saying. Who's going to pay back? Are we sure that they're going to pay back? And who has the ultimate fiscal authority to raise revenue to repay? Now, part of what Libra wanted to do was bypass this by buying securities. But then again, it becomes a bit of a sort of, I can relabel US Treasuries. I can buy them on my account and sell you a note called, Matteo's currency. But really all it is a treasury under a different name. But there are intricacies there that can get very complicated very quickly. My sense of the new project of Libra, I mean, the one that I've recently announced after pushback from the regulators, is that it has been substantially scaled down to being essentially a payment method. So it's gone back to being, something closer to PayPal. I might, for all intents and purposes, I want to say this very clearly, I might be mischaracterizing what Libra is. This is just my understanding from reading financial papers. Then a third element is the digital currencies that come from a central bank. So China is allegedly experimenting with this via Alipay. And again, my understanding is relatively limited, and it's a fast-moving picture. But those can be very interesting. They're essentially just nothing else than a way to lower transaction costs for users of the currency. So most of us are already used in some sense to having digital currency. We hold relatively few banknotes. Most of our money is in a bank account, it's an electronic entry, or we own securities on a registry. But there are massive inefficiencies right now in the Western world associated with that, particularly associated with making what should be a simple transaction, like a transfer of cash between two countries. The digital central bank currency can make very fast use of new technology to lower this transaction cost, and that would be welcome. It's an open question whether it's also going to impact the international use of these currencies. That we don't know. I think you're muted, Andrea.
The impact will be more on the payment system than on the monetary features and equilibrium across currencies. This is probably what we can say for this. Yeah. Okay. So we have a question from Enrico Cantarelli. I don't know if you can read it. Otherwise, Enrico, if you wish, you can take the question and speak directly.
Yes, with pleasure. Thank you, Matteo. Okay. Extremely interesting. One question I have for you is the following. After the Lehman bankruptcy, the markets were invaded with liquidity. Then we had the government debt crisis in Europe, and the market were again invaded with liquidity. And every time central banks try to reduce this amount of liquidity, markets reacted very violently. Seems that it was obviously very justified in the case of COVID, but it seems that the answer from central banks and from, let's say, the authorities in general seems to be always the one of putting more liquidity on the market. And it seems to have become a drug where it's very difficult to refrain users and markets from using it. Do you think there is an access to this situation which over time might become dangerous? Thank you.
It's a very interesting question. So I think two aspects. One is the liquidity provision, I think particularly for dollars, it's a symptom of the international role of the dollar. In a crisis, there are many reasons why the demand for dollar goes up. One reason is you're just scrambling for something safe as you liquidate your equity positions or your risky asset positions. Another reason is precisely because it's a very liquid currency, many lever players use it to borrow and make risky investments. And since they might not want to liquidate the risky investments at inefficiently low prices during a crisis, they need to raise the borrowing even during the crisis. And that also can increase the demand for dollar liquidity on both sides. And what the central bank of the US has done, certainly in 2008 and certainly again now, is try to flood the market with liquidity, essentially coming into the market and saying, if you want dollars, I'm happy to give them to you. Let me look at what happened during 2008, because it's a little bit more stable and we know much more about the data back then than we know for the data of this past March. Part of the reason was there was a lot of dollar demand from European banks for liquidity. Now, those banks didn't have access directly to the dollar funding liquidities at the Fed. So one thing that they could have done is they could have borrowed in euros from their domestic central bank, the ECB, and then go to the private market to change them into dollars. But that would have put even further pressure on the dollar to appreciate. And the central bank of the US decided instead to essentially make these dollars available either directly or in part through the ECB. So these are, it's part of the role that you have to fulfill as a central bank at the core of the monetary system is in a crisis to make this liquidity available. Now, there's a second part of your question, which is, when I think when they started doing it on a massive scale during 2008, there was a sentiment, I believe, profession-wise, that this is an extraordinary measure and that it will probably be phased out relatively quickly as we emerge from the crisis. I think the reality turned out to be somewhat different. In 2019, so almost 10 years or 11 years after the crisis, the balance sheet of the Fed was still quite large. And during the COVID crisis in 2020, has expanded again to unprecedented levels very quickly. So this seems to have become a slightly more permanent feature of a central bank activity that we thought it would be. Part of the reason is interest rates have kept being extremely low. So the traditional monetary policy, the ability to cut the policy rate, has been limited. And so they have to do the monetary policy mostly through these extraordinary measures. Do I worry about it? I mean, of course I do. Every time I see an imbalance that big, I do think it is our job as researchers to ask the questions. Is it safe? Is it not safe? What are the features that we have to worry about? Do I worry about it enormously? No. But it is something that I think we have to confront. A particular aspect that I want to mention, and this really isn't my insight, it comes from Narayana Kocher-Lakota, who is both a brilliant economist and a former governor of the Fed, who was discussing the idea of the Fed buying Treasury debt. So the Treasury of the US issues a bond, the Fed buys part of it. How does it buy it? It buys it with issuing currency. Who buys it is essentially the banks that keep that currency as a reserve at the Fed. Now the question is, do you count that one as a debt or not? And my understanding is that I think we should. All it is that the reserves of the central bank have become a pass-through for government debt. But ultimately, if I consolidate all the government, we made a promise to the public. They gave us real resources for a piece of paper that we have to either pay back somehow or at least keep stable unless we want to inflate. And so I think the accounting gets intricate, but I think it also gets interesting. I think it's easy to get these things confused or wrong. And I think that's what a lot of the research is trying to do these days. Let me take the next question. So I have to say, I only see, for some reason, I believe I only see a part of the questions. So I will let Andrea pick the questions directly.
Yes, okay. There are some which are connected, so I read together, which are more general related to economic situation. The first one is, I would like to know how you see the situation in Europe and in particular in Italy in the next oncoming years. This is a question of the general situation of the economy, and also related to Europe. It is, what is your outlook for Europe in the current crisis, and which measures should you put in place to face it? So two wide questions, so feel free to navigate them as you wish.
I have to say, I'm extraordinarily hesitant to answer those questions. I think the world is full of people that make predictions. As a research economist, I know that my ability to make predictions is rather limited. I think we have some good models, we have some good data. We also understand the limitations. So take everything I'm going to say, I would say, with a huge grain of salt. But I think the current situation is very difficult. I mean, that's obvious to anybody. I think the policy response has been relatively good, I would say, constrained, particularly in the case of Italy, from the fiscal situation. I mean, Italy is certainly not a country at the core of the monetary system, but I think I want to use some of the concepts that I've highlighted in the introductory remarks and transfer them to Italy. I mean, that is the power of having dry powder or fiscal space. It's your ability to fight a crisis. I think there is no doubt in my mind that if Italy had a 60 to 70% debt to GDP ratio, I would have envisioned spending 10% of GDP in debt to fight the crisis with fiscal policy. I mean, why not? It's a huge shock. It's going to have very negative effects. That's normally what I would have assumed would be the policy response. Clearly, once you are at the levels of debt to GDP ratio in Italy, that option is severely limited, and that means you're going to suffer more. So I do want to put out there the message that fiscal space does matter, because it's what gives you the ability to maneuver during a crisis. And unfortunately, Italy over the years has squandered much of its fiscal space, particularly during the 80s and the 90s, accumulating an incredibly high debt to GDP ratio. What is that? You know, the other thing I want to talk about briefly is the role of Europe, and in particular the role of the Eurozone. Just because I know that in Italy there's always a hot topic to discuss whether we're getting enough out of the Eurozone or not. I think there's a little bit of echo, and I'm going to try to fix it. I'm not sure if it's me or somebody else. Let's see. Oh, I think we're good. Thank you, Lorenzo, for pointing it out. So there's always this debate of, have we gotten enough out of Europe? And I'm not going to go deep into it, but I think one thing that I would like to mention is the ability to fight the COVID crisis without, and I mean fighting it from a national medical intervention, government policy perspective, without having to concurrently worry about a sovereign debt crisis, a banking crisis, and a massively depreciating currency. It's extremely valuable. I really want to emphasize that it is not common for a country with a high debt to GDP ratio and a floating exchange rate to be able to fight a crisis like this without experiencing the side effects. And you could imagine that if if on top of the COVID, you would have had to deal with a banking crisis, a sovereign attack, and a depreciating currency, that would have been a much more difficult situation for the government to face. I do think that part of the policy response of Europe has afforded us time to smooth the policy intervention and to smooth the shock without having to worry about all these other problems at the same time. That one is valuable. Now, there's a question of whether that was enough, how much fiscal transfers are going to be there. Those are all valid questions, but I do think there is a genetic sense that nothing has been done that I'm not sure I would subscribe to as an economist. That is not to say whether more could not have been done, but not recognizing that those are important features that allowed us to have time and some peace of mind to deal with the crisis itself. I think it's just not the right approach. Andrea, I think now you're muted.
Yes, correct. Just to avoid the echo that you mentioned before. One further point on this. You have mentioned before, it was also explained in your article this morning in Sole 24 Ore, which announced webinar. You seem skeptical about the possibility also in the long term of euro to become an alternative to the dollar, but probably also a real international currency. It is strictly related to the absence of a political union, of a real fiscal union, or there are also other more deeply economical reasons for this?
I mean, I think first and foremost in my mind, it is the fiscal situation. And the fact that we do have a monetary union, but we don't have a fiscal union, we don't have a political union. And that one creates some tensions that I think were there from the very beginning. In fact, I would argue were understood by economists, even at the very onset of the union, that I think make it unlikely that this would be a currency that is widely used internationally. Now, the question is how Europe will solve those problems. I mean, certainly anything that would contribute to a clearer fiscal framework would enhance the role of the euro globally, might enhance the ability of European firms to raise capital cheaply globally. Those are important issues. My sense is that we're a little bit stuck between a South who would like to receive essentially unilateral transfers with no oversight, and a North that certainly views that skeptically, and in some cases wants to go too far with austerity. I think somewhere in the middle, as usual, is the sweet spot. I would imagine as an economist, if I had to design the system, I would think of risk sharing, but also think that risk sharing right now it's a little bit unilateral. We start from very different positions, so we have to face that. But I think it's unrealistic for the South to expect transfers with no oversight.
Sure, and to rebalance resources when you know already where they go, probably in Europe, insurance mechanism could work better, like an unemployment scheme, which when you design it, you don't know which is the country and the people which are more favorable, or insurance scheme against catastrophic events like this one. But let's go back to other questions that we received, and we go back to China in particular. Someone asks if China economic growth is a threat to US stability, to dollar stability per se.
So it's an interesting question. I think there are reasons to believe that we have to worry somewhat. I think the main worry that you read in newspapers, and Andrea, somebody's asking you to mute again to avoid the echo as I speak. So I think the part that you read in the newspapers most often is that the Chinese one day will decide to dump their holdings of US treasuries in an attempt to destabilize the dollar. That one, I have to say, sure, everything is possible, but I find it to be unlikely and somewhat not my main worry. I think what we worry about from a theoretical perspective as an economist, it's slightly more aggregate phenomenon. In particular, I mentioned this idea of there is no alternative. And why do we worry when there is an alternative? So this goes back to an economist many years ago called Ragnar Nursk, who's considered the father of development economics. But in the early 40s, he was looking at the experience of the interwar period, before World War I and World War II, when both the dollar and the pound occupied an international role. And he conjectured that having two currencies at the core of the system, it's fundamentally unstable, because essentially as a global investor, you try to guess which one will go down first in a crisis, and you guessing and moving capital across the two can cause the instability per se. So in my own theoretical work, I sort of picked on this theme, and I sort of put together a theoretical framework that can help you think under what conditions this is true. And certainly one would be, the more you think that China might play an international role, the more you might have instability. Or also think of it a different way. Why is it that the US in a crisis decides to constrain its policy and actually maintain the dollar to be stable and repay the debt? Well, because they think that this enhances their reputation, and on an average year, they can borrow cheaply, and that's advantageous. So you want to think of it as, in bad times, I behave so that in good times you trust me, and by trusting me, you give me more capital cheaply, and that's a good thing for me. Now, suppose that as a policymaker of the US, I make it clear to you that 10 years from now, even 15 years from now, you're no longer going to get this privilege, because 50% of it will accumulate to China, no matter what you do. Well, that immediately means that in the next crisis, you have lower incentives to behave, because you understand that in the future, you're not going to generate all these revenues that you were getting before, where you were the only player fulfilling this role. So this competition among reserve providers can have some negative effects. It can also, of course, have positive effects. I mean, here's two very simple positive effects. There's more GDP backing these assets. There's now two countries. There's much more fiscal capacity, and so we can expand the amount of safe assets. Another benefit is diversification. If you think that some of the shocks between the US and China are idiosyncratic, then having two provides some portfolio diversification. I think in general, part of the reason why I highlighted in my theoretical work the more negative aspects is that the positive aspects I felt were more well understood and somewhat easier to explain, while the negative aspects might have been slightly less obvious to people. And so we thought that we would sketch them out. But there's plus and minuses.
Thank you very much. I don't see other questions. Maybe
I have a few here, I think. Maybe
okay.
They're only on my chart. So let me see. Okay, so there's a question that I'm going to read aloud. Do you think that the current rising trend in nationalism worldwide will lead to a decrease in capital flows to the US and an increase in home bias that will lower the value of the dollar as an international currency? So that's a very interesting question. It's from Livia Amato. I think, again, if I look at the US, the Trump administration has probably been the least internationally oriented administration, at least in my memory, and certainly has made it very clear that they were happy to retrace from a number of agreements that are the backbone of the international monetary system that is US-centric. So for me as an economist, that kind of political behavior signals a lower commitment to serve an international role and to perhaps in a crisis constrains one's policy in the short run for a benefit in the long run. I think Trump says a number of things, but one that I think I'm going to highlight in this context, I think he was the only US president that I remember that mentioned explicitly not repaying US debt. I mean, normally if you're the US president or you're the president of the Federal Reserve, there's one thing you never do. You do not mention not repaying. Like it just, you don't. So now nobody takes it seriously. There are many reasons to believe that those are just words, but words do matter, and it does raise some alarm bells. Andrea, I think you're muted.
Sorry. One final part of questions regarding euro. I think this is the last. If the steps that the policy steps that you described as relevant, even though in principle there is always more room to make things, can be steps in direction of a fiscal union in the future, or in any case should be considered specific to this situation of the pandemic moment?
I mean, my sense is that, at least among economists, there is a clear sense that some fiscal mechanism, some fiscal framework will be an improvement. There are many intelligent proposals on what exactly the framework could be. But I think the problem is fundamentally political. I mean, it is quite clear that in the short run, whatever system we implement will have to feature transfers to the South. And that does make it a political question, as much as it was a political question in the early part of the Union to even have the Union or not. I mean, there are economic arguments, but then there are political arguments. I tend to be certainly bad at the political ones. I might be slightly better about the economic ones, so I'll stick to those. But I think having the steps that we're taking now are in part permanent. I mean, some of them clearly in the scale and in all of this, they're temporary. But the fact that they were taken, the fact that those discussions were had and these things were implemented, leaves a record of being able to do it again in a similar situation. And so I don't think that they're entirely temporary. Whether they're going to lead us to more integration, I think that's going to be largely driven by who gets elected. And I think here, the worry that you have, at least that political economists have, is whether the governments like the Merkel government might be going farther with its policy concessions and the German public overall is willing to do, and that at the elections that's going to show up. I think that's always the question, is what is the broader electorate is willing to do to make Europe work. It's going to be a big question for a number of years.
Thank you very much. We have still some minutes remained, so I will use these moments to ask you a question different from the topic that we have discussed today, and which is related to equity markets. You have just finished a paper which has been mentioned through not only through social but also in financial newspaper regarding the current expectations, if I correctly understood, of investors in this situation of financial turbulence. So if you could summarize the points, the thesis of this article, because I think that maybe on the current day life, on the immediate short term, the equity market has an impact which is even at least as important as the ones that we have discussed today. Thank you.
Absolutely. Let me do it quickly since we have 3 minutes. But I do want to acknowledge my co-authors on that work. One, because it's an Italian economist, Stefano Giglio, who's a professor at Yale and a fantastic Italian economist. The other ones are Johannes Strobel at New York University and Steve Hutkos at Vanguard. Vanguard is particularly relevant because what that study does is it reaches out to Vanguard US clients. Vanguard is one of the largest or the second largest investment manager in the US. You can imagine them as somebody where you have your account to make your private investments as an individual. We asked them questions about 40,000 people, 40 to 70,000 people. What do you think about the stock market? What do you think the returns are going to be? What is the probability the stock market will have extremely negative returns, less than 30% over the next year? We asked them the same questions about real economic growth. And for the last 2 years, every 2 months, we collect these questionnaires, but we also see how they trade in their personal accounts. So we can relate the answers they give to their trading activity. And during COVID, we did this at relatively high frequency. We did a survey immediately after the stock market crash on March 11, 2020. And what that one revealed was kind of interesting. It was an incredible shift to pessimism for both the stock market and the economy, somewhat less in the short run, but not in the long run. So returns over the next year were forecasted to be quite low compared to the historical, but returns over the 10-year period, not so much. There was also a very high jump in the probability of an economic disaster, so growth less than 3% per year for the next 3 years, and the stock market disaster, which is a return over the next 12 months of more than minus 30%. These are, very high. I think that for both events, they assign on average a 9% probability. That's extremely high. Historical probability is closer to like 3%. So it's like 3 times as much. And for those of you that are interested, because I'm going to run out of time, the article is on my website in English, but Stefano and I also did write an op-ed, un commento for Il Sole 24 Ore, which I think you can also find either on the website of Il Sole 24 Ore or on my own website. And it gives you a little bit of a sort of easier read or a more layman version of the research. Let me stop here. I want to thank everybody for coming and listening to me, and it was really a pleasure to be back at Louis, at least virtually.
Matteo, thank you very much for your so interesting words. We have been very happy to have you June the 4th, as we established some months ago, in spite of the pandemic. Obviously, let me remind you that we would like to meet you in person in Sala delle Colonne for another event, or in any case in the area of Rome when it will be possible for you to come and visit again Italy. Thank you very much also to all attending. We will be in touch soon for the next events, and thank you very much again to Matteo, everybody, and have a good evening. Thank you.
Good pleasure.
Ciao Matteo, grazie.